For more on that and whether or not we are officially out from the worst of it, I want to bring on our first market guest today. It'll be Ryan Payne at Payne Capital Management President joins us now. And Ryan, very interesting conjecture here when we look at it. I'm going to start by highlighting another friend of the show stands here, which it sounds like you're in agreement when we look at the moves recently. He says we're out of the woods because we've moved past a pretty important marker here, looking at the retracement levels in the S&P. Tom Lee, Fundstrat's Tom Lee, noting that in the last 6 instances when we've seen a 35% decline from all-time highs and you've recovered at least 62% of the losses, you've never seen the market dip back below that 50% retracement level. That would be 2794 on the S&P 500 right now. We're still holding above 3,000. So what's your take? Are we actually out of the woods here? Are you finally calling this a new bull market?
Well, I've been very, very bullish since I've been on your show the last couple of months, which makes me look pretty good right now, Zach. But I digress. I have to agree with Tom Lee on that. I think if you look at it, we've never retraced that far back. There are tremendous odds in your favor as a bull. And he's been right on as well. He's been very bullish here. And there's not many of us that have called for a V-shaped recovery. My firm's one of them. And I just think when you have this much liquidity, I learned this back in 08, 09, and you have this much pessimism and this much money sitting in the sidelines with cash, man, this is like rocket fuel for a bull market, which we're already in, by the way.
Yeah, I mean, you talk about those prior instances that we're talking about when you see that 35% dip, at least 35% dip from all-time highs. Happened 6 times when you go back and look at, what we're talking about here. You mentioned 08, 09. When we got that retracement back into the bull market territory, it wasn't until December 2010. It's happening quicker this time, if you believe it, because we were so quick. Again, a record collapse when we look at that 35% move that happened and bottomed out in late March. So, I mean, I guess the thinking has been because the collapse was so quick, the recovery should be just as quick. But when you're looking at the stocks now, I mean, we've seen some recovery from the tech sector, giving back a little bit today. So where exactly are you putting money to work if you do believe that you're out from the worst of it now? What would be the new leader to take over from here?
Yeah, I think you got to be careful here. Don't just buy the obvious trade. It's like, yes, we know Zoom is up because we're home quarantine right now. We know grocery stocks are up. It's like, that's very obvious, and the market's already bidded those type of stocks up, and the list goes on and on and on. But we have to start thinking about is the economy is starting to recover. The market's already telling you that. What does it look like when the market recovers? More people are driving, more people are flying, manufacturing picks up, production picks up. Well, that means higher oil prices, right? So things like energy, which have just gotten hammered here, they have much more runway on the upside here. Financials, if you get reacceleration of global growth, you start to see interest rates go up. That means their net interest margins go up. So I think the really smart money right now, and what we're doing for our client base, is we're allocating across the board internationally, value stocks, all the things that are still pretty beat up. Don't just buy the S&P. It's a tech fund and drag at this point. That's what we like to call it anyway.
Yeah, I mean, when we look at, you noted the cash on the sidelines. That is worth pointing out when we think about that historically. Right now, above more than 1.5 standard deviations above the norm that we've seen in terms of cash holdings among the major fund managers here. So, I mean, when you think about that and the amount of cash that still remains here, despite the fact that we're well off the lows, are you seeing this as more of kind of like a slow from here on out, now that we've gotten it, a slower recovery where money starts to trickle in? Because there is, as you've noted, not a lot of people who enjoyed the latest rally. So, I mean, FOMO does start to weigh on the minds of investors out there. So how do you see it playing out from here?
Yeah, I think the problem is there's not enough FOMO. I think, we mentioned investors took $1 trillion out of the market. A lot of these money managers, which always underperform, by the way, just put that out there, is they're sitting in cash, and you have this thesis of, the market's definitely going back down. The economy is going to have a double dip recession. Sometime in the fall, we're going to get a resurgence of this virus. It's common knowledge. Everybody thinks that everybody's sitting in cash. So that means everybody's looking for a dip. And that's why every dip's been so shallow, because that cash has to get back in the market. So I can see the market continually melting up from here, not a slow rise, just because there's so much cash that has to get in right now. There's so much pressure, Zach, on the upside that your risk right now is not being in. It's not sitting on the sidelines with protection.
Well, let's talk a little bit more about those risks too, because I don't want to fully overlook them, because we had Dan Niles, the Tory fund manager, on the show yesterday, highlighting he's been one of those who's kind of taken the other side, been a little bit more cautious than you and Tom have, talking about the risks out there. And one of the newer ones that I talked about on the open here was U.S.-China tensions. You noted back in 2018, we saw the market fall off to wrap up the year. If you remember what it was like over the holiday back then, once the U.S.-China trade developments started to unravel, and we're kind of seeing that now. So I would say there's some historical context in terms of investors actually caring about that. So, I mean, is that the biggest risk you see to having this maybe give back a bit of the gains that we've had over the last few weeks? What risks are you at least acknowledging as potential ones to watch?
Wow. Yeah, I think so little about the downside right now because I'm so afraid of missing the upside. But just a comment on China there, Zach. I mean, I think that was last year, right? Last year, we already had trade tension. We already know the U.S. doesn't approve what's happening in Hong Kong, and the market was up over 30%. So I'm going to go on a limb here and say it's probably a non-event again in 2020. But what you really want to focus on is the fact that you literally have the government throwing $9 trillion at the problem, and they're doing that so this thing just does not fail. And that doesn't even factor in central banks around the world, which have done a $6 trillion asset buying program. So I think it's just everything is rigged to make this thing go higher and the economy is to stabilize. So I can't even, unless it's the pandemic comes in worse than expected come the fall or something like that, I just think there's just too many cards stacked against you to have the market go down here with any sort of significant correction.
It does seem that the momentum is at least trading in that direction. But Ryan Payne, I want to thank you for taking the time to chat with us.
Always good to be here, Zach. Thanks.
Hey, investors. Zack Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.